But let's talk about all that's taken place overnight with respect to the US Fed. And joining in right now, we have Jahangir Aziz, MD and Head Emerging Market Economics Research at JP Morgan, as well as Adrian Mowat, EM Equity Strategist. Thank you both so much for taking time out. And Jahangir, going to begin with you. Clearly, a 50 basis points super cut that we've witnessed by the Federal Reserve, a very combative start for the first rate cut in the last 4 years. Your stance?
Sure. First of all, let me say hi to Adrian. We haven't spoken for a long time. Hi, Adrian.
Nice to see you.
So we had a 50 basis points of rate cut the day after the July non-farm payroll came in. So this wasn't surprising to us. And the way in which we were looking at the rate cut was that, look, as the labor market had cooled in the US and the inflation disinflation was continuing, instead of having one-sided risk to the growth and employment and inflation, you now had two-sided risk. So if you have two-sided risk on both the two mandates of the Federal Reserve, then they need to bring the restrictive stance, which the Fed themselves were admitted for a long time, towards neutral. And this was the way in which they would go to neutral. They would start with a 50. We, in fact, have another 50 for the next meeting and 25 basis points. So we have a pace that is significantly faster than the Fed. But essentially, the first 125, 150 basis points of rate cut is this move towards neutral. There are questions about where the neutral is. We will worry about that once we get the first set of rate cuts done. So it wasn't very surprising to us. In fact, it was in line with what our baseline was, and also the commentary that this is not an economy going into recession. This is an economy that's slowing down, but it's still strong. Labor market is still strong, as are the consumers.
That's exactly the point, right, Adrian? Because while 50 bips was not, out of the ordinary, but the fact that, the Fed is trying to hunker it down, trying to make it sound dovish, if I can use that terminology, saying that this move is only a recalibration to preserve the currently strong labor market from downside risks.
The Fed seems to be doing what their job is, right? And so the fact that they've moved 50 rather than 25, I think I'm not sure how important it is to really focus on that. As Jahangir is saying, we've got a balance of risk here between the labor market and inflation. And the Fed needs to move to what is a neutral interest rates. Now, Powell was being tested through many questions during the press conference about what neutral interest rates are. And when you look at the dots, there's a diverse opinion within the board of the Federal Reserve. But let's say neutral rates is 3 or maybe a little bit below 3. And that's the destination that we now have. But that's an interesting one for the bond market, because the bond market, I think, got ahead of itself with yields falling sharply. And the inversion of the yield curve is a record high, with maybe one exception during the Volcker years. And so I think this is an interesting one for markets, because I don't think it removes volatility from the interest rate markets, because it looks like yields on 10-year are too low and they probably need to correct a bit. And I think that'll then have some disruption effect on the equity market.
Okay, fair enough. Just wanted to get in a take, Jahangir, from you now as to what this really spells out in terms of what the US Fed could potentially do down the line, and give us a sense as to what exactly the projection is, while the Jerome Powell going ahead and saying this is not sort of setting any sort of precedent for what could come. The dot plot seems to suggest that there could be 2 more in the year ahead.
Yeah, so we have 3 more for the year ahead. We have another 50 for the next meeting, another 25, so we have 75. the dot plots are 50. We, in fact, go to that neutral rate that Adrian was talking about, 3. As quickly as July of 2025, the dot plots have it going to 3.5 by the end of 2025. So the dot plots are much slower than the pace we think that the rates should move from restricted to neutral, and the faster they move to neutral, I think the better position monetary policy will be with the balanced risks that both of us have been talking about, and the Fed. But I think that of this move to 3, I think the first 125, 150 probably is not controversial, and I think that move will happen reasonably quickly. The issue is that if you do have that move, that the Fed eases, where the labor market, where the economy is not going to recession, the underpinnings of the economy remain strong, balance sheets remain in play, remain intact. There's still excess savings with the consumers. Then a rate cut like this is going to extend the expansion, most likely, rather than upend it. And so if it extends the expansion and we get back to a stronger labor market, then I think the remaining 100-odd basis points of rate cut is going to be challenging for the Fed. And also that, you will have questions being asked, well, has the neutral rate gone up because of all of the pandemic-related shocks, et cetera, et cetera, et cetera. But I think the first 100 to 150 basis points of rate cuts isn't actually controversial at all, because that's where we need to go. And even if you go there, you're still far away from what used to be the neutral, or what can be the new neutral. So I think the first 100, 150 basis points of rate cut is pretty much we should price that in fairly convincingly. I think the real question is what happens in the November election. I think all of the Fed thing, concerns about the Fed essentially will disappear by the end of this week. And I think from the next week onwards, we will be pricing in the US elections, and that's a completely different ballgame.
Oh, yeah, absolutely. Adrian, I mean, we've seen a very matured reaction from US equities. I guess part of the damage played out last afternoon across the world. I mean, they climbed nearly 1% after the FOMC statement and then settled in a little bit soft, right? We've seen the DXY, which has seen a slip briefly to about 100, ended near about 101, and the 10-year yield jumped up about 6 basis points. What are we staring at from an equity market reaction now that this is done with? What the Fed is trying to indicate is that there is more in store before the year ends. Would that then really sort of raise red flags to bloated markets across the globe, that the US economy is in a problem?
No, I don't think it's fair to say that the US economy is as a problem. As the Fed was mentioning, the labor market data is less robust than it was. I would hardly call it soft. If you look at some of the Fed regional Fed's data, they've got relatively high sort of forecasts for GDP growth this quarter. So I think it's wrong to take this view that, gosh, we've got a 50-point cut, we should now start to panic about the economy. I'd look at another way, that the Fed had interest rates at a high level. This then allows them to have a fair amount of firepower to cut those interest rates, to signal that they're going to support growth and provide that confidence that's all important. So as we go into 2025 and the Fed is moderating interest rates, inflation continues to come down, so the impact on real income moderates from inflation. It looks for an outcome into 2025 of this, not even a soft landing. The economy is still growing. I think that is a favorable outcome. And I do think that the issue for the equity markets is obviously going to be around economic growth, because the markets are reasonably well priced, and we need that earnings growth to continue. And earnings growth at a broad level requires economic activity to be good. And I would take the view that one can be modestly optimistic about economic activity in the United States going into 2025, would still be, favorable to owning equity risk.
Okay, Adrian, as well as Jahangir, thanks so much for making time and speaking with us as to what the Fed rate decision really means, because there's a lot of moving parts and a lot of pulls and pushes to the commentary that we got.
If you like this video, then like, share and subscribe to ET Now.